Welcome everybody to 2025, week number 15 of the Build Weekly Roundup. We've got a lot in store for you. I think if anybody's been paying attention to the markets in the last couple of days, last week, you're gonna probably already know there's been a lot of volatility in equities. A couple of nights ago, there was a big uh, uh, sell-off in the treasury market as well. So,
Oh,
I'm excited to have Matt here kind of come and give us all his thoughts on what's happening, why and where it's
oh,
going. But in the background here, I'm going to let Matt just
oh.
intro this, but a little bit before my time. But this boxing match, I think Matt had a
And
good
you
explanation
gotta
of
hit him
what's
with the
going on.
jab. You gotta hit him with the jab when he winds up the punch. I've played a lot of Mike Tyson punch out in my day. These guys are not taking this fight the right way.
Well, these guys are some of the best of their generation. So what we've got going, what we've got playing back here is the one of the most famous boxing fights in all of history, Hagler versus Hearns. This was 1985. It's before I wasn't even around. This was 40 years ago. Um, but I think it's reflective of what we've seen since that announcement in the Rose Garden at the White House just a week ago. Feels like forever, but it was only 1 week ago where we got the Liberation Day announcement. So why do we have this fight on in the background? Um, this uh, this boxing fight is kind of it's a classic. And it's well known because the punches, the action is just as fast as heavy and heavy as you've ever seen. Um, they're just out there throwing haymakers. Um, this fight only lasts 3 rounds, but you just see this. Um, it's just like two cobras just from the get-go. They're just getting after it. And if you put into perspective what we've seen in the last week with, the bell rang at that press conference Wednesday afternoon, and my take yesterday, if you had asked me, that tweet where Trump sent out the message that he's pausing for 90 days. We can go through the specific details. But it really kind of, if you follow the equity markets, follow the bond markets, we just saw massive moves, haymakers getting thrown, tough market for dealers to operate in. The longs are getting crushed, the shorts are getting crushed. Um, and then at the nation state level, you've just got punches thrown, damage taken. So if you think about, yesterday, Trump sending out that tweet, I took that as kind of the bell being rung. It's the end of round one. We're just about to finish the first round here in the background. I don't know if you've been watching this while I've been talking over it, but it really, I think this first round of this famous fight really just kind of summed up what we've seen in equities, bonds, the dollar, everything, just in financial markets over the past 7 days. So just wanted to get that out there with a nice little intro to keep it fun. But
Matt, I
yeah,
mean, today people would argue with you today that, we were up, I'm just referencing S&P, we're up 9.5 yesterday, down 3.5 today. Do we see just vol tapering off? Like this is just the convulsion, then it settles down. What's the read there in terms of the first round, as you say, being coming to a close?
so those large moves, you always see the biggest up days in history. They always take place in the bear market, like these pockets of volatility. You see VIX spike. Um, VIX has settled. It's back up to above 40
Yeah,
today.
it hit over 50 the last couple of
Yeah.
days. Yeah, then it came down.
So the volatility actually, like the way it works, like if there's going to be, what was the largest drawdown we saw in the last few days? The numbers just don't stick with me. They get so big. Like
Yeah.
a 3% is normal. Like just if you're looking at if you're on regular, steady C's, a 3% plus or minus, if you, if returns followed a normal distribution, right, you'd be like, all right, at 3%, that's a big day. But when you get into these pockets of dislocation,
Yeah.
you see a down 7.5 and up 9.5. And that's just really a market where what's going on is dealers don't know where price should actually be. What's
Yep.
the actual price here? And it just operates through the order book, and it's vicious. Like it's brutal to try to trade around it. Most players, you know, aren't going to be able to do that and anticipate where things are going. It's very easy to get wrong-footed, and if you get caught on the wrong side of these moves, up or down,
Yep.
right, you can get taken out in a stretcher very quickly. So you see this in
Well,
bid-ask spreads. If you're looking on exchange, those widen out.
it's
Dealers
worth
want to step
Matt. It's
back.
worth mentioning that we operate an ETF that trades on the New York Stock Exchange, and over the last week, it's a bond ETF, right? So this isn't something that wiggles as much as equities. Our bid-ask spread is double what it normally is. Our volume is probably 3 or 4x what it normally is. And if you look at the trade tape, it's just top of the bid-ask spread, top, bottom. I mean, you can look at the
Yeah.
line. And that's a bond ETF.
Well, that's exactly. It's everything. Well, this volatility is hitting credit as well. It's hitting treasuries. Treasuries have been massive movers. Everybody's lining up. It's like the first response was, we can get into the duration chart. Why don't you put that up on the screen camera as we talk about this? So you've heard me talk about the last few weeks. We've watched the duration. We commented on it, distinctly. The first response, after April 2nd, the Rose Garden announcement, Treasuries got bid, right? Especially the long end, and you see that that gray line is the multi-year resistance. Like bonds have been in a bear market, right? That top line is kind of the channel resistance on the bear trend. It first looked like the bulls wanted to break out and Treasury yields wanted to come in, and that's where you see that breakout. And from a technical standpoint, if you're looking for a breakout on a trend line, if you see something 1 to 2%, most of the time you'd probably consider that fair game, and then the trend followers hop on and you start to establish course. Now we're only like a week into this, so there's a lot that can take place. But immediately after that breakout, what you started seeing was massive selling, 3 or 4 daily candles of the long bond just the bid backing up, just stepping away. And 4 days into that, remember, Tuesday evening during Asian market hours, you saw a massive sell-off. So the 30-year was off. I want to say like 23 bips was the widest I think I saw it get to. That's a massive move, a 23-bit move in the long bond in a single day. But what we saw is, I talk about these channels very closely from a technical standpoint. Let markets be your guide. We saw the long bond on that Asian hours sell-off tap the bottom of that channel that I've been highlighting here for the last 3 to 4 weeks. I've talked about this. What happens if we break down below that channel? Things get problematic from a monetary policy standpoint and a fiscal policy standpoint if long end rates start to blow out. You've heard Scott Bessent talk about this extensively in his interviews. He said a lot of interesting stuff on the podcast circuit over the last 1 to 2 weeks, I would say. Those are worth a listen. I'd recommend them. I listened to one of those last night. There's a bit to gain from hearing the Secretary of the Treasury speak and answer questions, straight from the horse's mouth. But had we broken below that channel and gone down, the momentum is going to pull through, and it's going to become harder and harder to get the yield curve to stabilize and come back in. So that announcement from Donald Trump Wednesday morning, right, came out and said, "Hey, we're doing a 90-day pause. The 10% tariffs are going to be left flat across the board on all trading partners. China's going to be the only country that gets the tough treatment right now. Everybody else, you get to extend 90 days, which is basically the 4th of July is what we set the calendar to.
Yeah.
But that decision, that timing, that announcement, 100%, you won't fully hear it acknowledged, but it's very clear in Donald Trump's statements. He was looking at the bond market. He was listening to what Jamie Dimon said on, I want to say Fox Business on Wednesday morning. So it's time to step in. That was why that pivot had to be made. So if you think about it, like the way I view this, that was the ding, ding, ding of the bell for round one. The punches were thrown, a lot of damage taken. U.S. throws some punches, China throws some punches. It's not a perfect analogy because there's also the EU at the table here, Russia's at the table, UK, etc. There's a lot of other players, but the main fight, the pugilist, it's US, it's China. A lot of punches thrown. And in the end, it's like, how do you score this round, right? I would say from the US perspective, you got the 10% tariffs on that you wanted if you're this administration. You got the China treatment on. You took some heavy damage. You got a cut above your eye. The U.S. equity market sold off hard. There's a lot of losses on people's equity portfolios. Rest of world is selling out of U.S. equities. That's the main driver of said losses. So they're also, selling down. Dollar, we'll talk about the dollar in a second, but dollar continues to fall. And then the bond market, you've seen a rally in the 2-year and especially the front end. Up until the 5-year, I would say, was pretty much unscathed this week. But the long end of the bond market also didn't go out, right? It didn't get KO'd or hit the mat, but it looked wobbly, and that's not necessarily what you wanted to see. But you get through the round, that the long end, the bond market gets, you kept it from becoming a true problem. You can go to your cut man in the corner, put the little thing on there, stop the bleeding, stop the swelling, and continue the fight. But how do you score this one? I don't know. From some tech, we'll know. We won't know until the next 2 rounds come out. But this one looks like maybe it's
Matt.
10-9.
This is a narrative that's been swirling around the drain. I know we've talked about it, but boxing analogy: the bell rings, the guy turns around, and the other boxer gets one punch in after the bell. Obviously, highly illegal. Talk a little bit about China's treasury holdings. It's a narrative. I don't know what to make of it. That they could put pressure on the long end of the yield curve by selling treasuries. Is round one over? And I know you have strong opinions on this, so I want to get your take.
Well, yeah, call round one over. That's arbitrary. We're literally making that
yeah,
up.
I get it. It's an analogy. Yeah.
The headlines are always rolling, but that's to just put an end point on an opening chapter. So this question is okay. If you think about it, who has the inventory here? What matters? The U.S. bond market matters, and the dollar matters. Gold also. Maybe we'll get into that. I don't have the chart up, but that's a huge part of it. So if you're China, it's been over a decade now that they've announced it is not in their strategic interest to continue stockpiling U.S. Treasury debt as a reserve asset. And you can see it in their holdings. They're not adding to them. So if you're looking during Asian hours, the sell-off, what's actually going on? Somebody is selling treasuries as a forced seller. Part of it is there's one take on, hey, is leverage pods blowing up? Someone's leverage is getting liquidated, and it's basically a forced margin call, and that'll work itself out, right? That's probably part of it. There are leverage players in the game who have to sell to cover their borrowings, right? This is just the 40-year credit bubble. Asset managers, everybody's running on levered up positions. part of that short selling though is a short. Like you can think about capital markets in a global context as it's just one front of attack where the war can take place, right? So there's constant threats of, hey, will my kingdom, come under attack through a short attack, right? And if you think about this new policy that's been implemented, like the punch is landed, it's on, like the tariffs are happening. It's not getting rolled out now. It's not getting rolled back. We can't unring this bell. There's a lot of capital outside of the US that does not like this. You can think about why. The tariff policy means they are not going to have access to dollars to the same degree that they used to. If they want to execute the same, merchant and trade driven kind of framework or access to dollars that they've become accustomed to since the settlement post World War II. If they want to continue doing that through, we'll manufacture in our home country and then we'll export into the U.S. market. We'll trade our goods at the American ports and swap for dollars there. That kind of payment chain of dollars and dollar creation exporting to the rest of world in exchange for goods. Well, what the tariffs do is and they say no, and so if you want to keep doing that, like you're going to pay the U.S. government now with a fat tariff, and instead, like you're a price taker, right? It's whatever prices in the U.S. economy settle out at. You're going to leave with fewer dollars. And at 10%, it's like, yeah, you'll leave with, a little bit of a hit. If you're talking like the China tariffs, where it is now, let me bring up the chat. Like, what is the current rate of
145% is what they're
145%? Yeah.
I mean, at this point, it might as well be pull a number out of the hat. Okay.
Like you're leaving with basically like 40% of the dollars that you're used to. But that's just your revenue, and that's before you pay all your cost of production. So this makes exporting to the U.S. like massively less profitable from China's perspective. So what we're saying is the dollar faucet has just been shut off essentially. Like you could say like, yeah, it's still open technically if you want to pay the tariffs, but from a P&L standpoint, Chinese manufacturing exporting into the U.S. market just does not look appealing at all. And the only safety valve, the immediate reaction to accommodate for that from China's perspective, besides retaliatory tariffs, is to weaken the CNH, the offshore Chinese yuan.
I saw they lowered that into a lower band, I think, right, in terms of their peg.
They broke the band. Yeah, they reset the band. And their band isn't something that's like held for, if you look at the Middle Eastern countries, the oil exporters, you've got a lot of those like the UAE dinar, like they've held their peg for like 40, 50 years. The yuan peg, the trading ranges, that is nowhere near as strong of a dollar peg, and it's had to fluctuate. And this is just like that's your first body blow. So if you're like, yeah, that is a point scored. That's a haymaker landed for the U.S. to go back to that boxing analogy. But man, there's so much to unpack here. I don't even know what. Like I had like comments 2 and 3 geared up. There's so much to get into. But it'll come. But I think the key thing on duration is we had to maintain that channel.
Yeah,
and that was done.
That's my last question on this, Matt. I know you want to move on. It's hypothetical, so maybe this is useless. What happens if it breaks? It goes basically the long bond starts trading above 5% yield, and we lose it. What's the Fed's reaction here? How do we react?
So your typical monetary policy classic tools, interest rates, QE, they're not as effective here as you want. It's it's a different set of market forces. So let me go back. I remember the second point I wanted to talk about was the short attack, right? If you're a foreign country, so you're a Chinese manufacturer, like anybody who exports into the U.S. market and relies on U.S. dollar, offshore, euro dollar capital market funding to, finance themselves, they hate these policies. In some cases, it might even be existential, right? So if you come under existential threat, you are kind of backed up into a corner and you're left with, you got to fight, right? You can't just grin and bear it and take this. You have to come out and try to force a bond market repudiation of these policies. And this is where you hear is called like the Liz Truss moment, right? If you go back to September 2022, right? Liz Truss just took power, or just won the coalition prime minister seat in the UK, and within 30 days, after presenting the budget, tax reform policies, the bond market, UK gilts just sold off and forced her resignation, forced a new PM, and that was, what's going on here, market speaking. Markets are actually made up of incentivized players. Remember, in the big picture sense, think about them in terms of Mr. Market, right? It's just you trading with, think about general, like the market encompassing just everybody as one person, the general public. But at a micro sense, it's actually made up of informed, incentivized, individually motivated players, just like you, from your perspective. The difference between you and those players is they're massive, right? Yeah. And they can move markets. Yeah. And so when we're talking about these players, we're talking nation states, central banks, huge corporation, like just massive balance sheets who can mount these sorts of attacks and do the bulk of the action, over the long term on your financial charts, right? So when you see this short attack, what they actually are trying to do is force that Liz Truss moment on the Trump administration. Yeah. Now, the U.S. is different, right? This is the U.S. dollar. We hold certain advantages. Talk about the first disadvantage. Just the system design itself forces the U.S. If the system wants to perpetuate itself, the U.S. has to go deeper and deeper into debt, right? From a public standpoint, and that's where you draw the line. The advantages we have, right? We talk about money printing, right? Technically, this is all debt. Like you're building up, you have to pay it back. These are IOUs. And to create more debt-based money, credit-based money, you have to sign up to pay for something, down the road. What this tariff policy is it basically shuts that door. We're now following a kind of a mercantilist approach where we're going to seal off the borders. There's still international access to the U.S. Consumption market. You can still come in as an importer. It's just not going to be on the same favorable terms that you were used to the last 70 years. That's closed off. And then from a financial sense, we do not intend to be shipping dollars overseas to the same degree we have been, or the world has gotten used to bail out not just our own credit bubble domestically, but also the offshore Eurodollar credit bubble that you hear it commonly talked about. And all of these, a lot of policy set you've been kind of following if you track the threads the last 5 to 10 years. SOFR is another example of this. We're not going to do the offshore, or we're not going to do the overnight repo markets settled in London, unsecured, off of a survey of overnight desks at 8 to 10 money center banks in the City of London. We're going to require it's going to be settled at the FRBNY, Federal Reserve Bank of New York. We're going to require U.S. Treasuries posted as collateral. It's going to be centralized and not opaque any longer. But all of like from a systemic standpoint, that's literally what's happening is we're closing off the kind of the dollar leakage on this system. And the U.S. is saying like this debt situation we're getting ourselves into with the exponential growth in the debt, that's done. We're not having that anymore, or we may not be done. We may have to continue it, but we're saying like we're not just going to let it happen. We're not just going to status quo, slow walk ourselves into a debt crisis like as the end of the road. So there's a lot of parties who don't like that. They mount a short attack, and you now, if you're the U.S., you have to defend against that. Now, what do we have different than the rest of the world, right? Well, we're sitting on the dollar franchise. And part of these actions is to maintain the value of the dollar franchise or the nation state itself. If you think about it, you're only as good as your money. What do we have to defend ourselves? Obviously, we have a money printer. Like you can have the Fed come in with QE and and fund the public debt, so the nation state can keep acquiring the goods and services and resources it needs to accomplish what it wants to. That's kind of the MMT framework, but it's only a small fraction of the overall puzzle. So you can do that. You can technically never run out of dollars or default on those dollars, so long as you have the central bank and faith and trust in that institution. But then the other ace up the sleeve is this other story you've been catching. In February and March, it really picked up steam, the physical delivery of gold to the U.S. Now, there's a huge camp this is like decades long at this point, of Fort Knox skepticism, right? They think the gold is gone.
Yeah.
It's been loaned out. Fort Knox is empty. We don't have the gold. I am, highly confident that the physical gold is there. And not just that, we've been taking massive physical delivery in February and March. Those deliveries have been called from the City of London. They're coming in from Europe. And on top of that, we've got, domestic gold supply that can be mined out of the ground. That's where if you look at the chart on GDX, that is showing a very bullish behavior. So on top of that, there's gold supply inside the U.S., up and down the Rockies. Pull it from Canada too if we have to. Gold is not on the import tariff list. So if you read between the lines there, you see what's going on. But what's happening is you've got that ace in the hole if needed. This is in case of emergency break glass. Say we did break down and the treasuries start to sell off on that channel, which I think we ultimately do. I think there will be upward pressure on long-term yields, but I don't think it's right now. Eventually what you do is you remonetize the gold stack, you mark it up, you go through, you follow the Bitcoin Reserve Act. Cynthia Lummis had some details in here. The Bitcoin Policy Institute details this pretty thoroughly. All you have to do is mark up the Treasury's gold certificates from $44 an ounce up to whatever the number is. Current market price is $31.75, and it set a new all-time high today. So when you're setting new all-time highs, it usually means with your trend, you're not done, right? Where does this wind up? Who knows what the number is? But all you have to do is mark up the value of the gold certificates from 44 to big number. That's going to create a cash deposit in the TGA, the Treasury General Account at the Fed. Fed is the fiscal agent. The Fed doesn't actually own the gold. They're not even the custodian of the gold. They're the monetary custodian of the gold certificates. And you think about it, how did we acquire that? How did the U.S. Treasury acquire the gold? It was in the bailout of the financial system in the Great Depression. So the 6102, all of that. That's how the U.S. acquired the gold to monetize the banking and credit system out of the deflationary collapse it was in the Great Depression. So what happens? Technically, the U.S. is self-custodying, if you think about it, Fort Knox, Army Reserve, and then it's scattered throughout some other facilities. Fed is just sitting on the paper certificate version as custodian. They're the interaction with the broader financial system. You've heard Powell use the term, they're the federal government's fiscal agent. You go through, what does that mean? It's a deep can of worms. But what they would do is essentially they would create the dollars if the Treasury instructs them to mark up the gold certificates. That creates dollars in the TGA that did not have to come into existence in a borrowing framework, right? Normal dollars, everything we've seen, the last, like since 1971, right? They have to be borrowed, right? They're ledger, book accounting transactions for the federal government to access dollars. It has to get them. You can tax, right? But our tax revenue hasn't been covering spending, so that shortfall has to be funded through borrowing, right? So the dollar creation is attached to an IOU, and everything we've done so far has just been someone has to buy that IOU. QE means the central bank is going to buy that IOU, which is really the part of that process is that we need to dive into this book review series. There's a good one that goes on to it, but it's the transformation of public debt into bank money. And why does the nation state want that? When the liability becomes bank money, you get purchasing power at 100, right? Versus even a T-bill is a good example of this. Public debt as money doesn't get full purchasing power, right? Even, you hear Stephanie Kelton talk about T-bills as like different colors of the same money. They're not the same thing. Bank money and public debt are not the same thing. The public sector needs banks to create bank money to do that transformation to maximize purchasing power up to 100. But the in case of break glass that we have, everybody knows at this point, post 2008, everybody's been doing QE. We all know it. Everybody else in the game knows it. We know that trick has kind of run its course. It can still get turned on, right? You can still utilize it, but you're not going to get the bang for the buck you used to. But now, assuming we have the gold, the in case of money or in case of emergency break glass is to mark up your gold, which is just a pure monetization of the credit bubble, and those dollars hit the TGA. It requires zero credit expansion. It is inflationary, but if you do that, technically you don't have to tap the long end if you don't want to. Like most of the government funding in the bond market is at the front end. Like even you could say you go up to 7 years, 10 years. Those auctions are nowhere near as big as like 5s, 3s, 2s, and bills.
Yep.
So the majority of the funding is front end anyway, which the market is going to buy, right? They want lower duration. And then on the long end, you've got some natural buyers, your pensions, your insurance industry, who naturally is your willing owner of long-term IOUs because it matches the time horizon of their liabilities. So there's always some amount of funding on the long end. If you remonetize the gold, in this speculative attack that the Treasury curve would sell off, someone who doesn't like these tariff policies and wants to, force a Liz Truss moment, for lack of a better kind of label, you're fighting a losing fight because we're sitting on the gold. And that's why you see, it's been very clear since November 22, gold is in a bull run, which has also been very clear since mid 2015, which has also been very clear. If you just look at the chart of gold, like versus credit monies, it's always in a bull run. It's just a matter of time horizon. But the point is now gold is being marked up because of these underlying dynamics.
Yeah.
And if you're coming at, like, China's been acquiring gold, so maybe they can try to force the policy if they want to. But we've been loading up the gold inventory as well. And this is why, in my opinion, you're seeing the gold, behavior from a technical standpoint looking much more like a bull market that everybody picks up on. It's very obvious, right? Like, gold sells off a bit, like, okay, but it sold off Tuesday. We're right back at an all-time high today, April 10th. It's just a very strong bull market. It's low volatility, dips bought very quickly, which is a bit different than the Bitcoin bull market we've seen since November 2022 as well. FTX collapse happened there. It's at the bottom. Everything bottoms at the same time. Equities, gold, Bitcoin, you could say to some degree bonds, but not quite. The Bitcoin bull market looks a lot different because it's spent very long periods in consolidation, right? If you think about it, we went between like April and like I want to say like September of last year. Like, we spent 6 months in the middle of the year in a consolidation, a drawdown, and then the upswings just come in these big rips. And then you do what we're doing now again, like, oh, another drawdown. And from the standpoint of the actual participants in the market, like, most people don't think in long-term time horizons, like years, decades, lifetimes. They think in terms of today, right? And when you're spending that large of a percentage of the time in consolidation, and then your gains come in these big rips, it really attracts a different type of holder. You have to have like a multi-year time horizon and a deep conviction. Otherwise, like, it's just too hard to grind it out. Like, most people, when they put on a trade, if it goes against you, 3%, 5%, they're going to stop loss out of it just naturally. They'll sell. That's typically good trading practice as well. So that's how the textbooks would tell you how to do it. But with Bitcoin, like, even in a huge 15-year bull market, but underway in a major bull wave since November 2022 bottom, new participants coming in don't want to go through 6 months of an L before they get a big rip, right? Versus gold is just up and to the right. It's you'll take a little bit of a lull, maybe a month or two of a little drawdown, something here and there, but it's manageable and it just keeps riding. So gold is the easy ride, going up and to the right. Bitcoin is, same dynamic, but a much tougher pattern, I would say, or just underlying wave, or whatever you want to call it, for most market participants to ride out. Now, I do think in this context, we talked about gold being the obvious, like, in case of emergency, break glass. Like, yeah, the gold certificates are going to get marked up by the time this big boxing match is over. It's happening. It's like, I have a high conviction in that. 90% plus, something like that, is how I see this kind of materializing in the end game of this specific cycle. But Bitcoin, if you read the headlines, it's right out there for you. With the Bitcoin Strategic Reserve, you see states just across the U.S. just flipping on, activating. They're going to reserve as well. This is super important. The rip is going to come, but you're going to have to be patient. And that's where you just see on FinTwit, everybody is, their time horizon is literally one day. Like, it's what's happening right now. It doesn't even go into a week. They're just like, market's up 9.5% like yesterday. That's all they talk about. There's no context of even the picture in the week, the month, the quarter, the year, like the overall cycle. So Bitcoin right now, it's just too much shiny object. It's in a drawdown. Ignore
Matt,
it.
the problem is that
It's totally set up.
CNBC, Matt, the problem for CNBC for passive buy and hold investors would be really fucking boring.
Yeah. Yeah, you got to tell the story today. Gold sells off major. Like there were headlines on Tuesday of gold major sell. It's like, guys, are you looking at the chart? What are you watching? Or Bitcoin. But I was like, guys, are you watching what the state legislators are doing today? So yeah, you're right. There's no setup for a long-term time horizon on CNBC, FinTwit, et cetera. You're right, 100% right about that. And I know our show
What's
too, we're called the Weekly Roundup, Weekly Perspective, but I try to take a zoom out view. Here's a good leading indicator of this too. If you're listening to a commentator and they can only talk about this, what we're seeing this week is like 2001 or 2008 or, whatever, and it's only in their own limited experience, that's probably a signal of like, this is not a person who reads or market history. They don't have that many arrows in their quiver to draw to the case studies. Because like, if you're thinking about like, what is this thing like? Like, can you actually take what's going on today in your framework as like, let's say a dollar denominated investor, like your domestic US? It's like, okay, I can only translate this into what's happened in US markets for my lifetime. That's extremely limited. If you can't copy paste yourself over into, oh, well, this is how it operated in, the UK or the European perspective in the pigs crisis in 2011, 2012. That's great too. If you can see the cross asset or international capital framework. But then even better than that is if you're like, oh, this is like the conversion of or the transition from, the British pound sterling from tally sticks onto the Bank of England standard, like to draw from the long-term case studies. If you can get that, you're probably having some insights that can help you for the present situation to a much greater degree than just someone who's just had the horse blinders on for like what's going on today and how does it compare to the only cyclical bottoms we've gone into in, let's say, 2020, 2008, 2001. Some remaining practitioners have 1987, and then you can speak about the inflation of the 1970s from your childhood. But if that's all you have, it's not good enough.
Well, now we're moving on to Seeger.
Oh yeah, so we got to talk about the
can't.
dollar.
Yeah, I saw you put this up here, and I thought the reference was going to be to night moves because the moves, some of the big moves are coming at night in the Asian markets, but you're insisting that it's like a rock, which
It's a good point.
I don't care for that song personally, but
I like the night moves reference to because the action happened, the big action happens in the bond market. It's been taking place in the Tokyo, Shanghai, Singapore hours. No, I put this up here because the dollar's been dropping like a rock. And you see the tone of the markets, like, what key are we playing in here? Yesterday, when you saw the S&P 500 up 9.5%, bonds rally, like long bond rallied, just bounced off the bottom of that channel, strong move. And then 2-year sells off, actually, as you get a flattening in the yield curve. And so you talked about FX markets, this is where carry matters to investors. If your front-end interest rates go up, that should be attracting flows into your domestic currency. We did not get that yesterday. We have not gotten that this week. This is the weekly chart, but we continue this like, it's just, if you like, the blue highlight there is just this week, but this is, dollar is dropping. Talked about my channels here. We're into that part at the bottom of the channel where you're looking at cyclical bottoms where the dollar, you'll typically see an easing in the dollar. It's just, when rates come up on the front end, dollar is not picking up in FX. This is where, go listen to Scott Bessent directly on, the podcast circuit so you can hear it from the horse's mouth. There's some notion, like, we know we need a weaker US dollar for if we actually want to support, U.S. manufacturing, but Bessent and Trump still, claim very steadfastly they're supporting a strong dollar policy. It's like, well, how can that be? This is not working out. I don't know that that's actually factually true or not, but dollar's dropping like a rock here, hence the Bob Seger song. And we can get into the greatest. And I always thought Like a Rock was one of his top of the playlist, but you're right. It's on his greatest hits album, but it's not recognized as the greatest hit.
It's supposed to be symbolic of someone who's standing strong in the face of adversity, but I don't know if that's the dollar. Wait, Matt, can you? So this chart goes back to 2016. You have these channels drawn. I have the longer view chart in front of me. Can you explain how you draw these channels? Like, there's history prior to this snapshot. You want to zoom in. How do you get to these channels? Like, what's the technical analysis here?
Oh, well, it's just like you just hand it over. This is like the fifth grade brain, still up here. That's like, just get out the crayons and draw. No, what you're looking for, there's a lot of truth in that. For anyone who only has one tool in their quiver, and it's just like, technicals, like that's it. Like, it's probably, like we talked about in like understanding history, all of that. Like, you need multiple arrows in your quiver is kind of my opinion. And the technical standpoint, it's something, as I've become lead and responsible for portfolio management, very quickly realize like price matters. Like, you go through undergrad and get a finance degree, you go through grad school, MBA program, et cetera. You've been taught for 40 years, and this is kind of still, I don't know. I haven't been on a business school campus in a couple of years. I don't know what they're teaching the latest. But what you've been taught for the dominant paradigm is like efficient markets hypothesis. None of this matters. That is, in my opinion, wholeheartedly not true. And if you operate by that rule, that'll work in a 40-year bull market, right? Where literally it barely matters what price you buy at, because you got a Fed put, you got constant, treasury inflows. The credit bubble just gets reflated by rates cyclically moving and secularly moving down. Lower lows, lower highs the entire way. You don't need actual pricing tools or to focus on these things, but when the game changes, you come to realize you do need it, right? So when we talk about forming the channel, it's really just looking for price behavior. And you can this is a deep rabbit hole. We don't have the time to discuss this on this, but you're really looking for signals on what is price telling you. What are the key points? What are the trends? Where do the buyers come in? Where do the shorts come in? And it's really just thinking about, at the grand scheme of things, the chart patterns form themselves. We talked about the short attack, right? From the long bond, like to open the show, first chart. Why do you want to throw the short on? Why do you want the yields to sell off? It's like, well, we don't like these tariff policies. These are not good for our business. We need to short, get a reversal, and hopefully force the Liz Truss moment, get a change. And it's all about, you could say bulls and bears, but what it comes down to is who's winning, who's losing, right? And so price has to break one way or the other. You want to be on the right side of the trade, and ultimately, the stronger balance sheet will win out, or the stronger player will win this tug of war. And that's what you're really trying to do from a technical analysis standpoint, is identify where those points are or might be, where a trend's developing. And then if you have some broader framework for how the game is being played, you can plot that in there. And that's why, you want to do this and follow all the major assets out there, like duration, dollar, equities, all of that.
If you zoom this chart out, I'm just looking at the zoomed out chart, it looks pretty clear to me that if you zoom this out, the channel would be, the bottom of this channel would be around the GFC '08, and it's been on this steady incline. Is that pretty accurate? So this channel reflects the rise in the dollar since it hit the DXY, I should say, since it hit like 72 in 2008, right?
yeah. The dollar has been in an uptrend since
Yep.
2008. Yeah.
Okay.
Yep.
All right. Back to cedar.
Oh man, go to the next slide. This is why the like a rock. I know it's not his top hit. You got some great ones. Against the Wind, Old Time Rock and Roll. Just a true American living legend, right? But I grew up like was an 80s kid, but grew up in the 90s, and I remember these ads on TV. We're talking about American manufacturing coming back again, right? Our cars kind of suck relative to the rest of the world, but back in my day, we had Chevy trucks we were proud of. And the song playing on all the ads was Bob Seger's "Like a Rock." So I know I don't know, what is it, his 15th best song, but it's his number one best as far as advertising is concerned, and good old American metal.
And I think one thing to point out there too is that with a lot of our cars today, I mean, I know we're not going to go down this path today, but a lot of our cars actually have components from other countries, right? So even though it's a Ford, it's a GMC, it's a Chevy, I mean, you're still not able to buy something that's truly American today, which is unfortunate.
Well, I don't know if it's unfortunate or not. To make a car, what do you go? You go through like 7 layers of supply chains, and you
Yeah.
you go down to like like literally nuts and bolts, and it's like, where do you source those? And like by the time you get to the manufacturers making the final good, like the actual truck, they may not even know where the nuts and bolts came from. Like, so you go through, it's like if you actually look at the supply chains to put together a complex good, like like a truck, it's really hard. And so you want to source the components, like you have to do every step of the way has to be profitable, right? And there's certain things like, all right, to make nuts and bolts, like, well, you want to lower your labor costs. That's a much easier thing to produce than, let's say, a semiconductor, right? Um, so you might source the nuts and bolts from Mexico, or the semiconductor. This is where complex supply chains go into finished goods, and it's like by the time you get into it, it's the it's the paper. It's is it a Milton Friedman paper about the pencil, right, with the
Yeah.
eraser and how this thing is put together? Well,
Yep.
this is just like that on like 5 orders of magnitude bigger on complexity. Now, when you try to like put these tariffs in the game, you're like, we're going to get everything in America down to the screws, tires, the axles, all this stuff. It's like, good luck. This is going to be a nightmare. On top of that, you throw in the value chains at every step of the way. Every one of those components has to be made at a profit, right? Everybody has a number
Right.
that they have to hit. Um, and you're in competition as well. Like if one nuts and bolts manufacturer is overpriced, like, all right, I got to check my other suppliers. You go to 2 or 3, you see where the market is, and things work out. But what it ends up in is a truck that's you know good product, like a rock, and it's affordable too, relative to the wages. And yeah, rinse and repeat. That leads to more complex goods, satisfying people's needs on the Maslow's hierarchy, as well as some, desires, all of that. But when you throw the tariffs into the equation, you're kind of literally throwing the wrench into the complexity of this process, right? And the not just the transfer of goods themselves across borders, but the monetary transfers across borders. So if we just try to do this all within the United States, like for every good and service, it's going to be very disruptive if you really think about it. I don't know. We'll see how it goes. If you want to start going down this route, we decide this is the way we want to go. And I know we hear a lot of, there's a media talking point about this, like, no, American voters didn't vote for this. It's like, yeah, they kind of did. Like, it was pretty clear, like, Trump was going to do this. If you listen to any of his speeches at all, he's like, tariff's a beautiful word. It's the most beautiful. Like, we're going to, like, this is obvious. And if you voted for Trump, like, and this is the way the democracy moved, they're saying they're going to give this a try. So,
Right.
Let's see if it works. It's going to be very complex. Don't expect it to be a smooth transition at all. There's no possible way that this transition can operate smoothly. Like, There's just no way this is going to be a seamless
If you
process.
want
So,
everything to be made in America at a profit, I got bad news for you. You're going to have to accept a lower standard of living. Full stop.
for now, I don't know. We'll see. We'll see how this plays out.
Full stop.
All right. What's the next slide? Does that get us through, Cameron? We
Yeah,
can
so
get into
I think the next slide
VeriSign.
is VeriSign. I think this one's really interesting from a tech perspective as well. So I'll let you take
Yep.
this one away.
All right, VeriSign. Why am I talking about this boring company, right? VeriSign, if you're familiar with the name, this is, I want to say they're an S&P, they may not actually be an S&P 500 member. They're not that big in terms of market cap, $10 billion or that order of magnitude. What does this company do, though? It holds, you could think about it as the monopoly rights to operate the .com domain, right? It's I mean, it carries a unique charter.
And .net.
And .net. Yeah, there's a couple .nets out there.
Premium domains there.
Yeah, no one's ever looked at a .net and said, I wish I had that word on .net, not .com, right? But yeah, they do .net as well. So if you think about this, yeah, that should be a valuable franchise, right? It's kind of a monopoly business to operate. And that's how you hear a lot of equity kind of analysts or, holders talk about this. What I put on the slide here is got 3 lines, three squiggly crayon drawings. No technical discussion here, but the white is VeriSign. This is equity performance going back to November, the election date. Green is Mag 7, and then purple is GoDaddy. I put GoDaddy in there because they're actually the #1 domain registrar. They're the #1, if you think about it, the customer of VeriSign, right? They're doing 1/5 of the .com business. And if you register your domain, odds are, by far and away, GoDaddy is your largest market share. So if you look at the equity performance, VeriSign is kind of holding up like a blue chip holding. It doesn't sell off, or hasn't sold off yet to the same degree that the Mag 7 faster growth hyperscalers, all that AI focused large cap, your $1 trillion behemoths, have really struggled since the DeepSeek announcement. You did see the sell-off finally hit on tariff day, right, April 2nd, but they're still up so far year to date. GoDaddy, as the #1 client, the #1 customer of VeriSign, has been struggling, not to the same degree as the Mag 7, but at their February earnings announcement for Q4, they sold off massively. You can see that big sell-off on the purple line on the chart, basically calling for slower growth than equity analysts were forecasting. They're talking about growing 7% year over year. This is on an overall, big picture secular trend on internet adoption, right? But also the statement was made that rest of world growth would be slower than the U.S., right? So if you take this in the big picture context, right, of, so far the U.S. tech industry has dominated the business of e-commerce and internet, social media, everything going on where the revenue is just abundant and growing for 30 years, 40 years now, my entire life, in that competitive landscape. So if you think about it, like just to put this in perspective, Amazon.com, right? U.S. company, if you're a U.S. shopper, you log into your browser, Amazon.com, half the country is a Prime subscriber now, right? So you got a just crazy market penetration within the U.S. But then you also have a business in every one of the G8 countries, everywhere except for Russia and China, basically. You got UK, Amazon.co.uk, Germany, Amazon.de, France, Amazon.fr, even India, Amazon.co.in, Japan, Amazon.co.jp. My point is, these revenues, like what you're doing is like you've got this mega cap multinational corporation based in the U.S. That is earning revenues overseas, and this is just think about it from a taxation perspective. Like as a nation state, you want your corporations to have this advantage, right? And you're actually kind of, you say extracting flows, but you're also delivering a lot of value too. But the profits are being made and ultimately sourced and reflected in the capital markets of your country. That's why, Apple stock, or Apple running up, iPhones going, like iPhones are your dominant mobile phone, most countries, not China anymore, but everywhere else. Amazon, same thing. You could do Google. So this competitive edge, like why have the Mag 7s performed so well for especially the last 15 years and the post 2008 trend? It's really because, one, you're riding the growth trend, business adoption and of the internet, and then the economy's integration and alignment around the internet for where trade takes place. But it's also because the primary beneficiaries who own the market share are U.S. companies, right? And I like to talk about the prize, the oil industry. Dave knows this. I like to cite the oil trade as a case study.
I've only got like maybe 20 pages left, man. I'm almost done.
It's a doorstop of a book, but an awesome book. But to put this in analogy of the oil trade, right? You first realize that like the U.S. was the first to realize that we could drill oil with profitable unit economics and get oil out of the ground, and then you do something with it. You make useful goods and services, and so the oil industry went through this same integration and adoption into the global economy that we're seeing right now with the internet and semiconductors, right? But one of the things you saw starting at about the 1900s, Teddy Roosevelt comes into power, I think it was 1904, and he makes it his case to break the Standard Oil Trust Company. And so you started seeing headwinds against the just what looked like an unbeatable juggernaut that Rockefeller and Flagler built up over 30, 40 years in the late 1800s. And that opened the door for other countries to set up their own kind of flagship corporates to get the other non-U.S. nation states access to the economic flows, the financial flows, which is a taxable revenue stream, right? This is where you get into the chartalism. Are they creating value? In my framework, no, they're not. It's demand. It's the fulfillment of human wants and desires that is the value creation. Businesses fulfill those needs, and then governments come in and look for a taxable revenue stream, and then the state will see to it with those ends once they earn their keep. But same way, 1900s, we saw the development. You saw the launch of Royal Dutch Company. It was a Netherlands company. They sourced their oil in Southeast Asia. I want to say Indonesia is where they developed their oil fields. Same thing with the Shell company. It was a UK company. They came up with the oil tanker, was their kind of innovation. But in that same realm, you saw, or in that same phase, you saw the U.S. domination of the oil trade, both globally and domestically, kind of get chipped away. You see the fracturing of Standard Oil, all of that. That may come down the road with antitrust. If you follow the news, this is another thread. We haven't covered it very closely, but watch Lena Khan, watch headlines you see. it's hard for people to grasp when they see Steve Bannon and Lena Khan coming out of a meeting together. But it's like, all right, if you look to history, that's your best case study, that's your guide. But that's part of this underlying story, I think, as things develop. But my point here as we go into it, what we're seeing with not just Mag 7, that's reflective of the kind of the regionalization, the fracturing of U.S. tech companies' dominance of this platform. We call it the internet broadly. You see GoDaddy breaking down with their Q4 earnings call in February. Watch VeriSign closely, is my opinion. And this is like telling people to follow a mid-cap stock. Why? Because .com is so important. Like, it reflects U.S. dominance of the e-commerce trend that's really pervaded our entire lives. So, Cameron, if you go to the next slide, why am I saying this? Like, VeriSign stock is barely broken on that chart.
Look to their Matt. I think you. Yeah. Sorry. I wanted to add in there too that and maybe you're going to get into this, but I was looking up. I think it's 5%, only 5% of VeriSign's customer base. You talked about GoDaddy and the Western domains was 5%. I think it's China, like Chinese domains.
They have no China risk.
Right, exactly.
I mean, China has no risk. Alternatively, they're not dependent on .com.
Right.
But if you look at their debt, they have 3 bonds, which is a tiny issuer, right? In the investment grade markets, that's not a big debt stack. They have 1.8 billion in debt outstanding. It's all belly maturities. They have a 2027, a 2031, and a 2032. That's not long-term duration. They're not a borrower, despite having a monopoly. The market has not been comfortable funding them longer term, which is the further you can issue your debt, that's a signal of, in the corporate space, that's a signal of a higher quality borrower from the supply of dollars perception in credit markets. But 1.8 billion, it's a very small issuer. They have about a $1.4 billion balance sheet. So they're really totally dependent. The assets of the company, they have about 700 million cash and liquid investments, about 700 million in servers, equipment to operate the .com and also .net registry. But it's all dependent on future cash flow, and that's where, if you look forward, Cameron, we'll go one more. You look at this 2027 bond. It's never traded that strongly, right? You've always seen spreads somewhat where they are today. But as I'm tracking, Cameron can talk about this, the all-to-all electronic trading that goes on between dealers, asset managers, everybody in fixed income markets. I'm watching everything very closely in investment grade corporates in 2027, 2028. And one of them that hits me is, from the perception from the equity investor standpoint that VeriSign is this rock solid kind of monopoly, credit markets, you're looking at a different story. This 2027, as front end rates have come in, the 2 years getting bid, it's cyclically moving down. You can see that on the top chart, top left. The white line is the benchmark treasury investment that matches the curve. You can see, like, since 2023, it's been this, in a yield perspective, lower highs, lower lows, and that's consistent with a downward trend on yields in the front end that we've been in. Cuts reflect this. That's where we're at in the cycle. Spreads have started to widen now for this triple B that's supposedly perceived as a rock solid monopoly business. That's your initial kind of leading indicator or warning sign that something may be going on under the surface. Because credit will usually tell you first. Like, the credit guys follow most closely the risk to the cash flows. And I would just say, keep watching this one. We'll see how this develops.
So
but what do I think? Yeah, go ahead.
Sorry, I was going to add to that. Overall, it was interesting. Overall, I think just the index for IG is like 121 right now. So this is higher than that.
But that includes 5 years out, 10 years out, and spreads 5 years. Like once you get
Yeah.
longer, like corporate spreads are actually struggling even more so than this
Yeah.
is like a 2 year and in bond
Right.
where you don't have like it's a lower duration. It's all reflect like more a greater share of a volatility will encompass credit risk.
Yeah.
So where am I going here? Cameron, you want to skip forward? I do have to wrap up. Um,
Okay.
what is this actually a sign of? I'd say, look, same way we talked about oil fracturing and the U.S. dominance coming to an end with Standard Oil, and then the other kind of nation state flag bearers coming in and gaining market share. Watch for that with tech, I think, going forward. This will be a longer term story, 5, 10 years. But if you look at what's going on, a good leading indicator was this France AI summit that happened in February. This wasn't your, AI conference of businesses or whatever, Salesforce, Dreamforce, that kind of thing, where everybody's just there for a party. This is the nation states sending their representatives, getting together for how they're going to divvy up the business. And France coming out of that as kind of the EU banner carrier, wanted to get all these nation states to sign on to agree upon terms. Coming out of that with some sort of letter, some meeting of the minds for how the nation states were going to agree to divvy up this business globally for the next whatever lies ahead. You saw the U.S. and the U.K. refuse to sign on. So it just goes to show like this fracturing is a story we'll continue to watch. But I think one of the most interesting things as a signal for that is watch market pricing for VeriSign. We'll leave it there.
And ITW.
And what? Sorry?
ITW, Illinois Toolworks.
Oh, I love Illinois Toolworks. That's different. That's manufacturing and supply chains. We'll talk about that later.
That's different. Still what I bid.
Awesome. Well, thanks for going
All
through
right.
that, Matt. I know this is a Matt-heavy episode, but any other items you want to leave the audience with before we sign off here? I know you have to go.
No, it's a volatile week. We might get a pause, like go back to that Hagler versus Hearns analogy. Like this is going to be a volatile transition to get through. I was hoping it'd be the end of the bell after that Trump tweet yesterday, the 90-day extension. Today's markets did not cooperate. Big bond move. Ag is down almost 100 bips. That's a massive move in bond world, and equity's down 3.5%. So maybe the breather, like technically it is a breather. It's lower volatility than we were getting before,
Right.
but it's not really. Like this is going to be a really, I just keep saying the word volatile. It's going to be a volatile year. All right.
Great. Well, thank you everybody for joining us today, and good luck out there. Like Matt said, it's volatile. All right. Have a good
All
weekend.
right. Take care.
Thanks, guys.